All right, breaking news out of Washington, D.C. The House Budget Committee and the House of Representatives as a body has passed a budget resolution which sets the stage for tax policy. This is huge because this budget resolution sets forth what tax cuts House Republicans and the Republican Party in general are looking for. And this matters because it only has to pass by a simple majority in the House and the Senate. Want to make sure everybody understands that. This is huge because typically you have to get over 60 votes in the Senate to pass anything because of the ability to veto. Republicans cannot get over 60 votes in the Senate on tax policy. I guarantee you they would not be able to do it because the Democrats and the Republicans are fighting on everything and they have a narrow majority in the House and the Senate. But with the passage of a budget resolution like this and going to reconciliation, the Republicans only need a majority in the House and the Senate to pass this, which they have. Now, here's what's on the table. This is what they are wanting. They have already said this. It is clearly outlined in their budget resolution. Here are the tax provisions and the policies you should expect to go into effect in 2025. This is huge if you're an individual or a small business owner. Record-breaking tax changes we had in 2016. Well, we've got the new set of record-breaking tax changes happening right now in 2025. Here is the first one I want to make sure everybody understands. Individuals are going to have lower tax rates. Right now, we have the Tax Cuts and Jobs Act from 2016 set to expire this year. In 2026, every individual rate is set to go up between 1% and 2%, no matter what tax bracket you fall into. High income, middle income, low income, everyone's bracket is going up in 2026, unless the lower individual rates are passed, which is what the Republican Party is wanting to do. They are wanting to extend that. And that's what's happened in this budget resolution. They are saying we are going to extend the lower individual rates from the Tax Cuts and Jobs Act of 2016. The next thing important for individuals, the child tax credit. It used to only be $1,000. In 2016, it was doubled up to $2,000. Now, it is also going to be extended because that's going to go away in 2025. They have said we are going to extend the child tax credit. Again, good for individuals, working families, those that have kids. You're going to continue to get the $2,000 child tax credit. The next thing, critical for individual business owners, 91% of Americans just take the standard deduction on their individual tax return. And frankly, it's lower middle income earners that typically take the standard deduction because they don't have a lot of write-offs and deductions to typically take, from large charitable contributions to mortgage interest deductions and all these other things that can add up when you itemize. But that is set to be reduced in 2026. The ability to take a large standard deduction is going to be reduced. Here's what it's going to be in 2026, $16,000. But if they extend the double standard deduction that was implemented in 2016, the standard deduction will be $30,000. So that is what is proposed here. They will extend the higher standard deduction. They call it the double standard deduction now, which is going to be $30,000. Double of what it's going to go down to. So that is huge. Let me just put this into context. A family of four making $80,000 a year is going to save $1,700 under this tax package because of the lower individual rates, child tax credit, and the doubling of the standard deduction. Now, some people win and lose more than others in that, but the average family working, making $80K a year is going to save $1,700 in tax cuts. All right. Now, that's the essence of the individual tax policy. There is one big one, though, that was kind of a curveball. A lot of people weren't knowing where the Republican Party was going to go on this, and that was the SALT deduction. Okay, SALT stands for state and local tax deduction. See, when you pay the federal government taxes, let's say you made $100,000, but you had to pay $5,000 in state and local tax, you get a deduction for that. And the federal government says, well, we're not going to tax you like you made $100K because you had to send $5,000 to your state. So we'll only tax you like you made $95,000. Well, right now, and this happened in 2016, they put a cap on how much state and local tax you got to deduct. This is property taxes, income taxes, any local taxes that you had to pay. Not federal income tax, but just all your state or local taxes. Well, they're going to remove the cap on that. What happened was they put a cap on this of, I believe it was $10K. In 2016, and this hurt a lot of people in kind of higher state tax states. such as New York, California, New Jersey, and a lot of people who might be making 200 grand, 300 grand a year. That's barely enough to afford a home in those areas are like, wait a second, I don't get the state and local income tax deduction. I might be paying $20,000 or $30,000 to my state and local governments for taxes, but I only get to take a $10,000 deduction. So if I paid that 30K, I had $20,000 I had to pay taxes on to the state and local government, and I had to pay taxes to the federal government on the taxes I paid. It's kind of insane. So they've removed the SALT deduction cap. Okay, that's what the House budget that was passed, the resolution, what they want. Again, this means the House and Senate have to come to reconciliation on this, but removing the SALT cap deduction is an interesting one. It's a good political play because, frankly, a lot of Democrat members in the House and the Senate in those states have had a lot of backlash on that because it's not very sensical that I have to pay the federal government on the taxes that I had to pay to the state and local government. It's a total double tax. And so there was a lot of outrage on that from both Republicans and Democrats when that cap hit. So they want to remove it. Okay. And that benefits individuals. All right. Because there would be no limitation on state and local tax deduction. All right. Now here's the big one for small business. And this is the one I'm probably most excited about, which is the qualified business income deduction, QBI. This is the 20% deduction that you get as a small business owner. Okay, so let's say you made $200,000 in the year in your small business. After all your expenses and everything, at the end of the day, you made $200,000. This is if you're a sole proprietorship, LLC, S corporation, and now you're going to pay taxes. Well, when Congress passed tax relief in 2016, they said, hey, big corporations, C corporations, your tax rate goes from 35% to 21%. Huge tax break for big corporations. That was a permanent tax break. But they said, let's give small businesses a 20% deduction, but we only made it in effect for 10 years. This is set to expire now in 2025. At the end of 2025, this will be the last year you get this 20% deduction. Well, they want to make this permanent, not just extend it. They want to make this 20% deduction permanent. So if you made $200,000, your only tax is if you made $160,000. You get that immediate 20% deduction on the income. Now you're only taxed if you made $160K. Huge benefit to small business. Frankly, when all the tax policy was happening in 2016, big corporations were there trying to get this 20%, 21% corporate tax rate. Individuals were there. Both people on both sides of the aisle there trying to get child tax credits for people with families, trying to get lower rates. You know, they're all this negotiating everything. And small business was getting zip. They were getting like nothing in this. There was some expense depreciation and stuff that helped big and small business, but really small business was getting nothing. That's how they came up with this QBI 20% deduction, which has been huge for any small business owner. I take this. 99% of our small business clients use the QBI deduction. It's a huge deduction you got to make sure you're getting, and that is set to be made permanent. Okay, that's what they're aiming for in the final resolution of the bill. Now, when I say resolution and the bill, I want to make sure you understand what's happening here. This is kind of how the sausage is made in Washington, D.C. This is their resolution that they passed from the House, okay, and for their budget. And they're saying, how do we get to these numbers of the budget we're setting? It's by all these tax cuts. There's some revenue raisers, by the way. They're going to get rid of carried interest. The carried interest favorable tax treatment for private equity firms. They're going to get rid of that, which is going to raise taxes on private equity, hedge, and other funds that get carried interest type income. So they're kind of going after Wall Street a little bit here to try and raise some taxes. But this resolution, they outline how they get to the final budget. But the tax changes still need to be passed in a bill by the House and the Senate. This is where they're doing this reconciliation process, where they only need a simple majority of 51 votes in the House or the Senate to pass this. They don't need the supermajority of 60 votes in the Senate to pass this. So the reason I say that is there's a high likelihood that what is in this budget resolution is going to get passed. Now, there's going to be some negotiating, some bartering and horse trading, of course. And we're also going to see some of the stuff Trump talked about on the campaign trail going into effect. No tax on Social Security. No tax on tips, okay? That's already baked into this budget. They're already planning for that into the budget. And so tax on Social Security for individuals, For any people who are tipped workers, that is going to go away too. So there'll be no tax on tips or Social Security as well. That is planned in this resolution. Okay, now here's what's going to be happening next. Now the House and the Senate are going to be negotiating here on final bills. They have to pass similar bills. Okay, they can't pass one and the other passes the other. They have to get a identical bill passed, because what happens here is the president actually doesn't even need to sign this thing. Now Trump's going to sign this. He's been all over this in terms of what he wants and working with the Republicans, his own party, and trying to get these tax changes. His hands are all over this. Okay. So, but it's really up to Congress to pass this in the House and the Senate. But here's what's been happening over the last decade with tax policy. We get a bill on Monday, it's passed on Wednesday. Trillion-dollar tax bills, massive changes in tax policy affecting individuals, small business owners, people paying Social Security, tipped workers. I mean, all this stuff we're talking about will go in like 48 hours and it's now law. And it's crazy and insane. It's not the best way to run government, but it's what's happening right now. So I wanted to make sure you know what's going on right now, what's happening, what's on the table, what's already in the budget, because they have to pass tax policy that can fit within the budget they want to pass. And all this stuff I've just talked about. Removing the state local income tax deduction, keeping the double child tax credit, $2,000 instead of $1,000, doubling of the standard deduction from $16,000 to $30,000, making sure that stays intact. No tax on Social Security, no tax on tips, some of the Trump stuff that he talked about on the campaign trail. And then for small business owners, the 20% deduction on your income, that is going to go permanent. That is their plan, not just a 10-year extension, but a permanent move there on the QBI small business 20% tax deduction. All right, now make sure you're subscribed to my channel here. I'm going to be giving you updates on this. I'm going to give you the actual sausage once it is finally made out of Washington and tell you what actually got in the bill here. There's going to be a few surprises. There always are. There's something we didn't think about or didn't hear about. And but we'll be letting you know what those are, of course, here, because you need to make tax planning now. You need to know what to be counting on here in the future years. And this is imminent right now because all of these tax changes are happening here in 2025. And as Trump promised and the Republicans, as they got into office here and took power, is that they wanted to make these extensions. They made a ton of promises of what they said they were going to deliver for the American people. And this is it.